data in the U.S. has been fantastic recently. What do I do with that information?
Well, I think it depends on which part you look at. If you look at the consumer spending side, the job market, as you see on Friday, they have been really robust. I think the fact that U.S. consumers continues to be in, well, cautious but still in spending mood, I think that's helpful. But if you look at some of the business surveys, like the ISM numbers we saw earlier this week, and also some of the business confidence numbers, those are looking pretty weak.
Yeah.
So I think you do have the divergence between strong consumers and a soft corporate spending, and that to me is still running the downside risk to the economy, because at the end of the day, yes, consumer spending is 2/3 of the U.S. economy, but corporate spending, the housing market explains a lot of the fluctuations in the U.S. economy.
And I think if we asked you at the beginning of the year whether we thought U.S. markets and stock markets would outperform and bond markets would actually do well, I think most people thought, or do badly, I think most people would think, no, that's not going to happen. But the exact opposite happened, right? Yeah. So what does the second half look like now?
Well, I think the combination of stock bonds portfolio still works and still beat cash. We saw that in the first half. Yeah. But you're absolutely right. The fact that stock outperformed fixed income in a significant way, and also more risky fixed income like high yields outperformed corporate investment grade and government bonds. That again was very much against what we thought at the start of the year. Now, going into the second half, I do think fixed income still has a role to play, especially if you look at some of the investment grade towards high yield, where you are getting 5 to 8% income. I think that consistent income is going to be really important as we struggle with weaker growth in the U.S., weaker growth in Europe. I think that, to me, still more a bias towards fixed income still makes sense as we get into the second half of the year.
And you're avoiding, or you're cautious on high yield because there is still some yield there too.
Yeah. Well, I think the high yield space, I would perhaps move towards the more quality end of high yield. I mean, at the end of the day, if you look at corporate credit spreads right now, it is consistent with strong, robust growth in the U.S. economy. And that, to me, we may or may not fall into a recession, but I think the deceleration is still very likely. So from that perspective, high interest rate is still trying to do its work through the economy. We've not seen the worst yet. And therefore, I'm still wary of a potential spread widening in the high yield space going into the second half of the year.
You say we may not get a recession, but do we need sort of a recession to see a sustainable bond rally?
I think that would be helpful. I think what you could have is a two scenario. One is low growth for a long period of time, and the Fed doesn't have the urgency to cut rates. I think that, to me, will be the bigger challenge. Or you have a sharper downturn, and that forces the Fed to change direction. That could be the end of this year, could be early next year. I think that will be a bit more helpful in giving the market a bit more direction. We're talking about how things are a bit quiet recently. Yeah. We need some of the catalysts, whether it's the U.S. economy showing a bit more signs of slowdown, be more cooling, or for China to look, more lively. I think these are the two things that we've been looking for since the start of the year, and frankly, we've got neither so far, and that's why, it's been a bit of a struggle for the first half of the year.